Hey, this is Jerry from the Money Vikings podcast. Just wanted to say I'm really enjoying what you guys are doing, and keep it up.
Hey, what's up, chinchilla pickers? Hey, I want to give a special shout out to the Money Vikings. That was an awesome voice message they left us. I thought at the end, I couldn't tell if that was the kids screaming or if that was the start to CSI Miami and that theme song. But no, we really appreciate it, and we want to send people their way too because they've got a great podcast. They put a lot of thought and a lot of effort into it. And hey, also, there's another podcast that I listened to earlier this week, the Chewy Piranha podcast. Very interesting podcast and very funny. It's just a few friends sitting around and shooting the breeze, talking about life, dating, sports, you name it. Their perspective's very, very entertaining and very unique, so please go check them out. Also, hey, you're listening to us. You're on our, 4th episode. It may seem like the 400th episode, but whatever. You like us. That's why you're here. Hit the subscribe button. We're on Spotify. We're on Apple. We're on Overcast, Undercast, Mediumcast, whatever you're listening to us on. I don't know anything about these podcast apps or technology, but what you need to do is hit the subscribe button because I know that helps us. I see it in my analytics. I see it move us up. So please subscribe and subscribe to the Money Vikings and subscribe to the awesome Chewy Piranha podcast. Yeah, I also want to mention the fact that my co-host, David Underwood, is unable to join me today. He has had another adverse reaction to the vaccine, this time his second shot. And I don't want that to discourage anybody from getting the vaccine. It's, it's still going to be worth it. He's still going to be inoculated. So, or, I don't know, science, is that the right word? It's, you know what I mean. So, maybe we won't be on teams anymore. Maybe he'll be across and he'll maybe be able to breathe in my direction. That's weird. Why did I say that? Anyways, we hope Dave gets better soon and that he feels better and he'll probably be with us next week. So we'll see you then. Also, before I get into the show, I want to mention that I'm not a licensed financial professional. Consult a fiduciary. Fidelity, whoever you want to talk to, whatever. Just don't buy that whole market efficiency theory because it's ridiculous. But also don't sue me, okay? Because I told you I'm not licensed, so I'm not liable. But we do have some great ideas here. We're just trying to educate, entertain, inform, uplift you, blah, blah, blah. Listen, I've tried to record this podcast over and over again. I keep messing it up. And the first time I did it, okay, I've told you hundreds of times with my Anchor.fm ad, well, not hundreds of times, I haven't been doing this long. It's only been a month. But my Anchor.fm ad tells you I'm not good with technology. I shouldn't be trusted with it. Honestly, it's a miracle to me. I'm on Spotify. I don't know how I am. Blah, blah, blah. Okay, I recorded an entire 40-minute episode, and I thought it was like, this is going to be the best work I've ever done. I was so proud of it, and I went to edit it, and I deleted it. The whole thing. It's gone. So now, my voice is sore. I'm a little frustrated, but we're going to plow through this show, and I'm not going to edit it, and I'm not going to stop this time, because I've stopped too many times now, and my voice is sore. We're just going to get through it, okay? You're hearing me live, and that's kind of a special treat. Let's just look at it for what it is and make lemonade from lemons or lemons from lemon, whatever that is. Just let's look at the bright side. You're getting me live, and that's pretty cool because obviously I don't know what I'm doing as far as editing. Maybe eventually I'll be able to edit it, but not now. I'm not going to do it again. I'm not taking that chance. Let's move on. Let's talk about the thing I wanted to talk about today, and I've talked about it a million times already. You're just hearing it for the first time, though, right? So, stonks. I want that word to die. I want it out of your vocabulary, and I want its brothers and sisters, hodl, and to the moon, and all that. I want it gone. Get rid of it. Don't say those words again. And the reason why I'm saying this is because it promotes the idea that you can just buy a stock and wait for it to go up. How many times have you heard somebody say, you only lose if you sell for a loss? It's not true. I've got an entire list of companies on chinchillapicking.com. I just published an article called How to Grade a Stock. And you can look at some of Wall Street's favorite stocks from the past, whether it's Enron or Toys R Us or Sears or Nokia or whoever. All right. And we're going to talk about Yahoo tonight. I didn't put Yahoo on there. But there's a whole list of companies that if you would have held, you'd be holding the bag and there wouldn't be anything left in it. So let's put these words to rest tonight, okay? And the only time, if you're ever gonna say the word stonks again, be it with a stonk that you're trading and not holding. Because it doesn't do anybody any good to hold a stonk. That's not the purpose of a stonk. The purpose of a stonk is to momentum trade or day trade and then get out of it. You set your stop loss and you leave. If you want to go to the casino with a stonk, you have my blessing. If you want to do 5%, okay, of your portfolio, I'm fine with that. But set your stop loss and don't look back. And it's not always easy, by the way, to tell the stonks from the stocks. The meme stocks are easy. You know, you can tell. But it's not always a difference between Apple and AMC or Microsoft and GameStop. It's not always easy to tell. You can see this list. There's plenty of stocks that became stonks. Or stocks that were always stonks. And people just thought they were stonks. Let's take a look at Yahoo. And the reason I want to bring up Yahoo is because the dot-com bubble has been very much in our everyday conversation now with the NASDAQ being in correction territory, entered correction territory. It's probably not there anymore, but it did dip 10%. And a lot of people are always afraid of the dot-com crash happening again to tech. So we'll talk about Yahoo. It was definitely a Wall Street darling. In fact, the market valued Yahoo at $97 billion in 2000. That was its market cap. The revenue for Yahoo in that year was only $70 million. So that means the revenue of Yahoo in 2000 was 0.07% of its market cap. Now, people who hodled this stock until it was bought by Verizon for $4.48 billion in 2013 lost 95% of their investment. Do you still think it's a good idea to hodl your stonk? I never thought I would say that phrase ever in my life. Hodl my stock. If you would have said that to me a year ago, I would have, what the hell are you talking about? I would have committed you to a mental institution. So let's play a stupid game. It's called Stonk or Stock. And as I said before, it's not always that easy to tell the difference. We're going to use the article I published on chinchillapicking.com on how to grade a stock, and we're going to go through the different methods of grading. I've got 14 questions for this company, Facebook, to see if it can pass. Now, one missed answer here, or two, or even three, that doesn't matter. What we're looking to see is, do the majority of these questions wind up being yes for Facebook? And the first one here. Do they spend less than 30% of their gross profit on selling, general, and administrative costs? If it's less than 30%, they get a yes. The answer is 26.21%. Number two, is their gross profit margin 40% or better? The answer is yes. It's 80%. That was for 2020. Now you could say, well, the whole COVID thing and staying at home, that really pushed Facebook stock up. And you're right. So let's look at 2019. It was 82%. Even better. Number 3. Is depreciation less than 10% of gross profit? If it's less than 10%, you get a yes. It's 7%. So Facebook gets a yes. So far, we've got a stock on our hands, people. 2019. The depreciation was 6.5% of gross profit. So even in 2019, still doing well. Do they have little or no interest in expense when compared to operating income? Yes. Their interest expense is less than 10% of operating income. Still going good. Net earnings, are they on a historical uptrend? The answer here is yes. Now going back 5 years, are they historically generating cash and equivalents? No, it's uneven here, so we're going to give them a no, but remember, this does not disqualify Facebook from being qualified as a stock. Is total current assets minus total current liabilities a positive number? Sorry, you hear my chair squeaking here. I'm not editing it out because I'm not going to take the chance of deleting this episode. So is it a positive number? The answer is yes. When you take their total current assets and then you subtract their total current liabilities, you get $60,689,000,000. This company will have no problems paying off short-term debt. That being current assets, when you look at that, current assets is all assets that can be valued within a year, and total current liabilities is all liabilities that's going to be due within the year. Now, the next question is total current liabilities divided by, total current assets divided by total current liabilities. Now, I thought that I might take away one of these questions and just erase it when it comes to total current assets divided by total current liabilities, or total current assets minus total current liabilities. The reason is if you take total current assets minus total current liabilities, and if that becomes a positive number, then total current assets divided by total current liabilities is always going to be greater than 1, or equal to 1. So I thought that I was going to maybe take one of these out, but I decided not to. And the reason why, I think it's important to actually see these numbers. So if you take total current assets divided by total current liabilities, if the answer is 1 or greater, then you've got a good company on your hands. They're not going to have problems meeting their total current liabilities. They'll be fine as far as that goes. And if it's greater than 1, you want to see how far higher than 1 it is. If it's less than 1, you want to see how much lower than 1 it is. So I think it's just great to see the numbers on hand. So total current assets divided by total current liabilities for Facebook, the answer to this is 5.05. That is greater than 1. So we get a yes on that. Do they have a low property, plant, and equipment cost? And the answer to that is no, because their property, plant, and equipment cost is 79% of their gross profit. So they get a no there. And then we want to look at the return on total assets equation. That's net income divided by total assets. Is this a high percent? Now the answer is 18%, which that might seem low, but it's not, because really if you take a look at any of your investments, you get an 18% year over year return. That's not bad. That's pretty good. So they're going to get a yes on that. Do they have sufficient net income to pay off long-term debt in 4 years? Yes. You know why? Facebook has no long-term debt. That's pretty cool. Their return on equity is 22.7%. That's good. They get a yes there too. Number 13 is a small portion of their earnings used for capital expenditures. It's 59%, so they get a no there. And then, do they have consistent EPS growth over the last 5 years? This is actually uneven, so we're going to give them a no there as well. But they have 1, 2, 3, 4, 5, 6, 7, 8, 9 yeses out of 14 questions. We give Facebook a rating of stock. That's what they're qualified as. Let's move on. Let's go to Fubo TV. Let's see if they're a stock or a stonk. Number 1. Do they spend less than 30% of their gross profit on SGA costs? No, they don't have a gross profit. Number 2, do they have 40% or higher gross profit margin? No, they don't have a gross profit. Do they have less than 10% depreciation when compared to their gross profit? No, they don't have a gross profit. Do they have little or no interest expense as a percent of operating income? No, their operating income is negative $300.8 million. Historically, are they generating cash and equivalents? No, but it's a new IPO, so maybe that's unfair. Total current assets minus total current liabilities. Is this positive? No, it's negative $189 million. Total all assets minus total all liabilities. Is this positive? Yes, actually, surprisingly, it is. Total current assets divided by total current liabilities. Is this equal to or greater than 1? No. Do they have low property, plant, and equipment costs relative to gross profit? No, because they don't have a gross profit. What's their goodwill look like? We're going to add this into FUBU because I was very interested to find out that they had a goodwill line item here. Now, when you're looking at goodwill actually is the difference that you've paid for a company. If you're buying a company, well, let's put it this way: if you're buying a company, the company is valued currently at $400 million by the market, and you pay $500 million for it instead. Then the difference between that 400 and 500, that $100 million, actually becomes goodwill. So that's where that comes from on the income statement here. Sorry, that's a balance sheet. No matter. The point is that a company like FUBU that's not making any money, that does not have a gross profit, has no business buying another company, let alone overpaying for it. The only reason a company like that would do it would be to try to inflate their stock value, or maybe they have to do it to survive. If FUBU is a streaming TV, their competitors are Disney, Hulu, Netflix, Comcast, CBS, and the list goes on. So you look at this and you have to think maybe they're spending to survive, but the problem is that the spending makes it harder for them to survive. Now, if I look at Berkshire Hathaway's goodwill, I'm going to see a rather large number there as well. And that's because if you're buying a good company, you're usually going to have to overpay for it a little bit. Because if you go and you buy a good company, the good company is going to have its market cap today at, say, $4 billion, right? But it's a good company, so the market cap's going to grow year over year over year. So the shareholders are going to look for you to pay for that. So if you're buying a good company with what Warren Buffett would call a durable competitive advantage, you're probably going to have goodwill on your balance sheet. The problem is FUBU has no business buying other companies right now. Let's move on. Is the return on total assets a high return? Not applicable here because they have negative net earnings. How good is long-term debt? $29.9 million. This is terrible for them. Do they have sufficient? And the reason is because they don't have net earnings. Okay, so when you look at this, do they have sufficient net earnings to pay off long-term debt in 4 years? No, they have no net earnings. Do they have a good return on shareholders' equity? No, they have no net earnings. FUBU, and I don't even have to count this up, you know it's a stonk. Lots of you are out there trying currently to find the next Amazon. Or trying currently to find the next Facebook or Apple or who knows what. The next Netflix if you're buying Fubu. The problem is that those companies are one in a million. A great majority of these companies are going to fail, and they won't make it to that level. So don't throw your money away. If you want to trade Fubu, be my guest, but set your stop loss and don't look back if it triggers, okay? You're going to thank me for this. I promise you will. Or at least you should. A lot of you may already be learning this right now with the NASDAQ being in correction territory, and a lot of stocks have been taking hits. And listen, if a company can't be valued accurately by the stock market because it doesn't have positive net earnings, then you're not going to be confident if you try to buy and hold this thing. So why do it? You can't find a real good reason here. And if you can't value it, you're not going to be confident with it. So when it starts to sink and you drop 20%, you're going to panic sell. And to be honest with you, I don't want you to be in that position in the first place. That's why I told you to set your panic sell. That's why I told you to set your stop loss. Because you don't want to be in the situation where you're down 20%. Now you're trying to figure out if you should hold it till it increases 20% again. But guess what? The market doesn't care what your average cost is or if you ever break even. The people who held Yahoo and Enron could vouch for exactly what I'm saying right now. And the problem is you get a correction in the market. The Fubus of the world are the ones that get hit the worst. The penny stocks of the world are the ones that get hit the worst. This probably should be a penny stock. It's not. It's trading at like $26 a share, which blows my mind. Let's talk about corrections, because I want to talk about signs of a bottom. You know what? Let me give you a story first. The whole reason why I'm going on this rant, I've learned this lesson myself the hard way. We'll go back probably about 10 years. There was a company called NXTID, and they released a product called the Walk It. That's a really stupid name, I know. I think it was taken from Dr. Seuss or something. But what the Walk It was a digital wallet. And it was actually a pretty cool idea, okay? So to open this digital wallet, you needed your thumbprint or your password. Either one. And it had one debit card that would come out. And the only way, like I said, the only way to get the debit card, you use your thumbprint or your passcode. And this debit card, every time it would come out, it would generate new debit numbers. So if you decided that you were going to pay with your debit card at a restaurant, the waitress or waiter walks away with your debit card. Doesn't matter if they write down this number or not, because it's going to change. By the time they try to use that number, it's going to be void. Pretty cool idea. Also, this one debit card linked up to your credit card, your bank account, everything you needed it to. So all you needed was one card fits all. Good to go. I thought this was a great idea. This was a penny stock at the time. And the Walk It hadn't yet been released. So I put a bunch of money into it. Right around the corner was Apple Pay and the Touch ID for the Apple phones. That hurt. Then they introduced the chips that go into the debit cards, And NXTID never changed their technology, so their debit card immediately became useless. I lost a lot of money on that, and I was searching for the next big thing. Listen, I'm not telling you to not try to find the next big thing. I'm just telling you the odds are you haven't found it. And don't spend too much money on it. And I would trade these companies. Don't invest in them. All right, let's go on to the market bottom. I want to talk about signs of a market bottom here. Okay, so the froth's got to go. if you're in a correction, the correction's not going to be over until the froth is over. The stonks with an N, they've got to get wrecked. People on your Robinhood Facebook groups, this is one of the other signs here, they're going to be posting about how they are done with stocks. But what happened to Zoomatica? What happened to Fubu? They're stonks. That's what happened to them. Nobody really had any confidence in them, and that's why they panic sold them. That's why they've dropped. That's why they've revalued. It wasn't a good investment. You'll get the gut-wrenching, arm-pulling, it's time to sell, I can't take it anymore, when will it end feeling. And then it'll be over. Now, investors and traders have to differentiate between recessions where something is fundamentally wrong with the economy that brings about a bear market, and corrections that are often just pauses in a bull market. This situation with the NASDAQ, I think it's a pause. Even if rates stay where they are or move just a bit higher, there's no doubt in my mind that Facebook and Apple will grow into those valuations. Hey, we'll take off if rates particularly in the 10-year, start to drop. Then again, it'll be to the moon. I'm just kidding. I hate that phrase. I already told you I hate that phrase. You know what? If you get to the moon with Facebook or Apple or any stock and you get a 20% in a week move, then sell it. You're lucky. 20%. That's a 1-year gain. Take it. But don't stand there and try to hit a home run with the Fubus and so many Zomedicas. Don't try to hit a home run with those. You're going to strike out. All right? You don't need to strike out. You get so many opportunities in the stock market. And I want to tell you a story real quick. I was reading Buffettology. It's about my second time. I shouldn't say about. It is my second time reading through it. And there's a story where Warren Buffett actually had a meeting with his baseball hero, Ted Williams. I think this is pretty phenomenal, given the technology of the time. Ted took the strike zone, and what he did is he carved it out into 79 different smaller zones. And he figured out which of those zones were more likely to get him a home run if he swung at the ball when it went through him. And so he would not swing at a ball that was pitched outside those zones at all. And now, that's really, really impressive to me. I mean, he didn't have the technology back then, the cameras or anything like that to help him with that mathematical equation. But he figured it out. And Ted Williams wound up being a Hall of Fame baseball player. You've got an advantage that Ted Williams does not have. You don't have to strike out. You don't have to go broke. Ted Williams struck out a ton of times trying to hit a home run. So why don't you take the stocks that are more for sure to get you base hits than swing and strike out on trying to hit home runs. That's my advice for the night. That's all I got for you. So everybody have a great night, and we'll see you next week.